Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a couple of different things. I'm going to start with the S&P 500 US housing market starts and yields of 1970s. And we'll see how this thing cycles through, much like I think we are cycling through today. And then we're going to look at some more data from Twitter. There's a lot of charts on there of uranium. I think there's some oil and gas on there as well, but I know there's a lot of uranium and how good they look. I mean, they look really good. Nice, beautiful wedge formations. We've got flag patterns. They're all breaking to the upside. So what I'm saying is a lot of things are aligning for a potential move higher. You can also see that in the S&P 500 and NASDAQ. So I've said this before that we could potentially see everything go up together. I think that time is now. And I've been doing a lot of thinking about how I'm going to structure my portfolio, the strategies around everything, and how I'm playing this bull market that we're in the middle of it. So I'm going to first go back to the 1970s. We're going to look at that together. We're going to look at the data in terms of housing starts, interest rates, which is I'm using the 10-year yield here. And then I'm going to look at the S&P 500 and see how these are all meshing together. The reason I'm choosing these things is because the housing starts is a leading indicator. That's what's pacing this, the demographics and the demographics interacting with the housing market. Everything else that people follow are lagging indicators. So it's kind of like you've got a baseball player, he's up to bat, and a lot of people are measuring batting average. They're measuring, can he hit a curveball or whatever it is. Those are all lagging indicators because we're looking at things that happened after the fact. What you could do is if someone is very bad at hitting curveballs and you know the pitcher's throwing curveballs, you could say, well, with some statistical probability that, this person is poor at hitting curveballs. This guy's a really good curveball thrower. He throws real hard, et cetera, et cetera, et cetera. And you can kind of say, well, he's probably going to have a tough time with this pitcher. That's kind of what we're doing with investing. And that's also what you want to look at. You want to look at leading indicators. Is the housing market doing well? Obviously, we don't know what the future has in store for us, but if the market conditions are right, or if the situations are right, you've got a higher probability of success than other market conditions. Either way, let's dive in here. Let's take a look and see what I've got. So on top is the S&P 500, and I've got this vertical line that I'm going to use as an indicator to move back and forth. We've got the U.S. housing starts in the middle here. I am going to throw a horizontal line on it. Right about the average was about somewhere in this range there, somewhere around there. And then we've got the U.S. 10-year yield on the bottom. And as we went through this this is the commodity bull market. It started in 1970 right here and moved on forward. This is the bull market of commodities. It happened during an increasing interest rate environment. This was increasing the entire time for the most part. Not the entire time, but for that long period of time, it cycled upward. There were times where it cycled back down, like this time here. And there's other times that it also had cycled back down. And what I wanted to show you is the relationship of interest rates, the real estate market, and the S&P 500, and kind of how this all correlates to each other. So if I take this and I were to grab the vertical line and kind of look at where this thing started, where it started to roll over, we saw a movement in housing starts, and this is a recovery phase here. This is when stocks do quite well, is when you're in a lower period down here, not when you get up in these upper areas, because that pulls interest rates higher with it. And I'll show you what that looks like. But this was a recovery phase. It did very well for everything. For the most part, stocks went up, and commodities were they were really, really cheap. And as you can see, interest rates were going up here. They were increasing. And then the stock market had a problem. Same with the housing market. So you can see that the housing market, this is housing starts, declined during this period here. That's the decline I'm looking at. And that also brought down the stock market, and it also brought down the interest rates here. So it was an overbuilt situation in housing because we had a bunch of inventory during that time frame. And we sold off during that period. And what that did is it set up a great entry point at the bottom here, at the bottom of the interest rates and the bottom of the stock market to get long on commodities. Commodities to stock ratio was incredibly cheap in the 1970 era here, right where we're at. And it was an incredible buy opportunity for oil, for precious metals, for anything commodity related and precious metals related. And we were at that bottom there. And as we sweep on our way up, you can see that the stock market went up, the housing starts went up, and interest rates were going up at the same time, all the way till 1973. In 1973, we built too many homes. Our inventories were flush with supply, and the demographic had pulled back some degree. So we had a recession at this time, and you can see how this all aligns together. And keep in mind, this was a lot more free of a market than it was back in than we have today. It seems like we've got a lot more people with their hands trying to control the markets with interest rates and quantitative easing and stimulus and bank balance sheet expansion, asset purchases, and all this other stuff. Either way, these were all kind of declined at the same time. Interest rates were still moving higher to some degree, but we had the stock market decline quite a bit here. And we also had the housing starts decline. And then what we saw was interest rates kept kind of trugging forward, and then they eventually had a decline over here. And those declines in the interest rates, if you kind of see here, that decline there, it kicked back on the housing market, and the demographic was still there to buy because we had a little bit larger demographic. And we kicked up into another expansionary phase of real estate. So when these guys talk about the three waves, this is what is driving it. Wave 1, wave 2, wave 3. Now, I don't think that those waves are inherent to the markets by any means. I think those waves are driven by the demographic, by the baby boomers, and the growth rate of population during that time frame drove this in the housing market. The demographic drove it, and it was the relationship of that demographic and the housing market interacting with each other, and also in their peak spending years as well. So we had a pullback here. As we sweep through, that was the bottom of the pullback, and you can see we had housing starts kick back up, and we had interest rates kind of pause down here, where basically the housing market kicked back on. You could see the housing starts start to kick back on here and really start to accelerate to the upside. And then you could see interest rates interest rates are a lagged indicator. So if I were to take interest rates, and I'll do this here real quick just to show you guys what I'm talking about. If I were to take interest rates here and kind of just, I can't do it on a new pane. If I were to take these interest rates and to overlay it on here, it's just a delayed action. This runs up, and then interest rates are lagged behind it by a little bit and start to come up right behind it. That slowed down the S&P 500. So you can see the S&P 500 came up to about this point here, and look at the interest rates kick on up here. The interest rates started to kick up, and then the S&P kind of just rolled over and went nowhere for a good period of time. And then eventually the S&P 500 got so cheap in relationship to everything else, and housing starts started to decline. We went into this is a very cheap stock market in relationship to commodities. Stocks were cheap against everything. And then we saw that pressure in the interest rate. You can see the interest rate here. I'm going to kind of just zoom out here. You can see the interest rate really start to drop here in that trend line going down. So that's interest rates coming down in a downtrend, and you can see the stock market really start to take off. So one can say that the interaction of the demographic in relationship to the housing market, which is this stuff down here, going into those expansionary phases. We were in an expansionary phase ever since about mid-1940s in here. This was an increasing housing starts that entire time frame. And our interest rates went up that entire time frame as well. And this here put pressure during some periods when this went up during that time frame. But this was really a strong period that interest rates impacted the stock market and went sideways. And we had a repricing of assets where commodities reprice themselves against the stock market. If we go look forward in the I already went over the mid 2000s. I already went over this and talked about that as well and how these went sideways. But we never were in we were never in a market that had an increasing interest rate environment in the 2000s for like a breakout. It was always in a downtrending fashion or pattern. So when we look at this and we're in this downtrending pattern, this here was a mini cycle because money didn't really rotate out of bonds and stocks were still favorable in this declining interest rate environment. But if you look, we definitely have a change in the interest rate where interest rates have broken that downtrend. We could be going into an uptrend. That's my opinion there. And interest rates going up means that people are selling bonds. It's money's rotating out of bonds and it's got to go somewhere else. You can also see that we're entering an expansionary phase of real estate. So all of those things are still there, and the pressures are still there, just like the 1970s and just like the mid 2000s as well. And where I think we're at, and I've talked about this before, is I think that we're in the mid-cycle wobble. Basically, this cycle there is this cycle here, and that I think this is coming eventually, where we're going to build those homes. It's going to be inflationary and all that stuff. So when we look at where we are in the cycle, you can see in the mid 2002 timeframe, right here, we had a 50% decline from peak to bottom. We're right at the bottom. We had a mid-cycle kind of wobble in this area here, and we had a pullback. And we're basically in the same spot as I think in 01, 02. We've had a pullback in the market in the S&P 500, and we've broken to the upside here recently. We've got a nice big bullish engulfing. That's generally an indication that we want to go higher with it, and we've broken the trend line to the upside. Low, higher low. Now we've got a new higher high and a back test off of that. So that looks fantastic for a move higher. This is where I think everything's going to go up together. We could see the S&P 500 go up. We can see uranium do some crazy stuff. And we can see oil and other markets go up with it. So obviously we've got the S&P 500 looking very, we'll say, stout for a move higher. The NASDAQ is also looking good. This is a clear break to the upside. You can see we've got a low, we've got a high here, and now we've made a new higher high, or I should say a new higher high. So that looks good. We could be entering a new uptrend here. And if you look at some of these commodities, they're also knocking on the breakouts of all of these. It's a breakout here, but we did a kind of a return move back to we had massive support on this line here, and I think we're ready to potentially head higher with the overall markets. So when we look at this, we're starting to see some buying pressure in the housing market again. It's kicking up a little bit. Is that a start of something? We'll find out. I don't want to prematurely say that we're just going to jump right into a housing boom, but it's something to watch. Seasonality is kicking in where home prices typically go up. Home demand goes up during this time frame, and things should be turning around and looking better. But overall, we're seeing patterns starting to break to the upside in a lot of things. Here's crude oil. Crude oil is also looking really good, and maybe we get that bloody nose that I always talk about, which is a continuation pattern to the upside. But we're breaking this one also. So we have a breakout, we have a retest, and then we launch, generally speaking. So it's not just one area. We're starting to see these things across everything. So that's good. And we've got some stuff I want to go over on Twitter real quick. We've got this is uranium versus natural gas. It's a ratio chart. And we're seeing natural gas really, or I should say, uranium's outperforming natural gas. Natural gas is really the one that's just eating it at this time. But we're at a very, we'll say, attractive level for natural gas. I am starting to look at natural gas, and I think a lot of the companies are also at very attractive levels. They are cheap in relationship to their cash flow. Generally, when that happens, you want to sell it, but this cycle is definitely different than other cycles, as we haven't really seen the production or supply response this cycle like we've had in past cycles. I don't know if that's because the price isn't high enough. Maybe they can't get loans. Maybe they can't get the funds because of all this ESG stuff. I don't know all the reasons, or maybe those are all the reasons. But natural gas is killer cheap right now. And that's what this is saying. It's even cheap against uranium, and uranium is one of the cheaper commodities out there. Here's another one. It says important inflection point for the 20-year Treasury bonds. I talk about yields and the increasing yields and people rotating out of bonds. So it says something tells me that they're ready to tumble. And what he shows here is a long-term chart of the 20-year Treasury bond daily log chart. We've got a big, massive downtrend. And we're creating this pattern here. We're coming up. We've got this other resistance line going across here. But if you look at what he's got here is a custom 84-period Stoke indicator, which is basically momentum. And it's a hidden bearish divergence where this thing looks like it's rolling over, it's losing momentum, and it's ready to break to the downside, where bond prices could go down. What that means is yields are going to go higher. The market conditions that we're watching in the real estate market, that expansionary phase, is going to put pressure on bonds to go lower from that inflation and money entering the system, money and credit entering the system from new loans against new homes. So that's kind of the cycle. And it looks like everything is tied together, supporting that thesis. Because in that thesis, bond prices go down and interest rates go up. The stock market will go sideways. Doesn't mean that it won't go higher immediately. I think we're going to go higher in the short term, but I think over a long period, we're going to be bouncing between a channel, much like, a channel that looks something like this or something. And right now, bonds look like they could potentially roll over. And this is a big long-term chart. You could even do a trend line coming through here where it kind of squeezes up into a corner here, and then eventually will break down that momentum. This is uranium still doing its thing 4 years after I highlighted the breakout and ARC-based forecast. And you can see it's just not me noticing this breakout, but it's breaking out on his chart. We're also kind of at the edge of the ARC. So what they do is we come up, we consolidate kind of sideways for a little while, hit the ARC, and then we break up to the upside, and then we consolidate sideways to the edge of the ARC. Could we go sideways a little bit longer? Yeah, we could. That would be great, because then I could accumulate more of my favorite companies. So other people are also noticing it. We've got oil on log scale. It says things could get really out of hand during this decade. Oil is still the most important energy source that we have, and we don't do much new drilling. A visit to the upper band would spell disaster for inflation up and crush many currencies. So this is a log chart of oil, and we've got a resistance line coming through here. You can see when we broke that resistance line, it rocketed higher, came back and did a retest, went sideways for a little bit, and created another trend line. The recent, we've got this area here is, from this point onward, that was a disinflationary low interest rate environment and was in the housing market called a recovery phase. So this was the recovery phase here. This phase is an expansion phase of real estate. This is an expansion phase of real estate as it goes up. And then this was an expansion phase of real estate in the 1970s all the way to 1980. So expansion phase on this side here, this was a disinflationary lower interest rate environment through here. This is a mini boom here with credit expansion. That credit expansion and money comes into the system, putting oil into a shortage. That's why oil is such an inflation sensitive commodity. Went on up, and then we went into another disinflation, and now we're in another expansionary phase of real estate, credit expansion phase, where we're going to go much, much higher, I think, for oil. Looks fantastic. We've got URA, the Golden Cross, fresh off the oven. This is URA, and you can see that we are in a gigantic pennant formation coming to a corner here, ready to break out at any time. Now, could this go a little bit more sideways for a month or two more? Yeah, it could. It could. But things are coming to a corner. That's when technical chartists get very, we'll say, excited. We're looking for breakouts. We're looking for patterns. We're looking for things to break things. Before those breaks, what they typically do is the buyers equal the sellers before the break, and then you get reduced volatility in the price. So this volatility can get less and less and less and less and less all the way to the corner, and then it will break out and do some gigantic move. But we're seeing it across the board. You know, we've got oil doing it. We've got uranium doing it. We've got palladium here doing it as well. It says bouncing almost 4% today from the 3-year long-term trend line support. We are not out of the woods yet, but this is a bullish falling wedge pattern here, and we're starting to get some buying pressure here right on a support line. That support line is this green line coming through here, and we're coming right into a falling wedge. And if we break to the upside, palladium could have a run too. A run in palladium and bullishness in palladium is also going to be bullish for platinum. I am a bigger platinum bull just because of how cheap it is against all the other metals, how cheap it is against palladium as well. And I think platinum is going to be the one that's going to outperform perhaps all of the metals. But palladium's also looking good in this falling wedge, and we are about to break to the upside. That's one to watch. We have another one. This is Centris Energy. It says Centris is starting to wake up again, and you can see a trend line that is being broken right now to the upside. We're doing a little bit of a retest, and we can see a big move out of this company in uranium. We've got URA versus UX1. So this is URA, the ETF, URA, the mining companies, and some other stuff in there, versus uranium, the commodity itself. So if we look at the ratio here, we've got one massive bottoming pattern. A big, gigantic downtrend here. We have a gigantic base, and then we've got a resistance line coming through here, this resistance band area. And we are very low in this ratio where we have massive upside potential of URA, the ETF, to outperform the commodities, uranium itself. So this is exactly what I like to see, what I look for, how I value things. This is exactly what I look at. And with this ratio as low as it is, I think URA has a long runway, valuation runway, to move higher. And when these go higher, URA is going to outpace the commodity itself, uranium, and uranium is going to be going higher as well. It's not one going down and one going up, which really drives the ratio higher. It's going to be both going up. It's just URA is going to be going up at a faster pace. So it's coming. It's coming for those that are patient. And, you know, keep in mind, you know, since 2020, I've been a big bull in uranium. And everyone's like, well, you're a perma bull. I'm like, no, I'm a bull because look at this chart. If you say otherwise, I mean, you obviously don't understand what we're looking at. This is why I am so bullish in a lot of different commodities, because they're all showing that a lot of these ETFs are cheap against the commodities themselves, and they're about to outperform. And some are outperforming in the near term. This is what makes me bullish. Here's uranium. It says, every down day brings doubters. Had plenty of direct messages over the last few days calling uranium trash. Is it really that hard to zoom out? You just take a big picture view. Here's our basing pattern of the double bottom, and we're starting to break to the upside. It generally pauses here because it paused there for such a long time before it. And then once we get through that resistance, you're going to get a big old move to the upside. This one is UU in this instance. Here is Josh Young. It says, China reopening. Look at the jet fuel demand rocketing higher. More to come as international travel restrictions are lifted. It's bullish oil. You can see the demand here as they have opened up, and you can see this thing just rocket higher here over time. So yeah, there's a lot of demand coming, and the reopening is going to take time. It's not going to be instant. And hopefully it doesn't shock the system. We could see big moves in oil, big moves eventually in natural gas, depending on the weather. But yeah, these things are setting up for a lot more demand for energy. Here's one that says, way up in our market, buyers returned in force about 2 weeks ago, back to multiple offers in many price points neighborhoods. Not as extreme as 2021, quarter one, 2022, though. That's in the Denver, Boulder area. This guy, he lives by me, apparently. Or her, she lives by me. But yeah, it looks like the housing market is kicking back on in a bunch of different markets. And I did post the real estate market. So I said inventory's low, but it's up 65%. We've got days on the market increases to 75 days. It's up 13 days year over year. And then the median listing price is 8% year over year. So this is your active listings. You can see that we are up in active listings, 65% year over year, but we're coming from a level that is really, really low down here. We are still below 2017, 18, 19 numbers, and even 2020 here. So we're very low on our active listing counts, but we have increased inventory from a very low number. If you look at days on the market, the days on the market are nothing too out of the ordinary. We are still at a very low level, definitely not anywhere near a normal market, and we'll see how this thing progresses. And then for median listing price, we're up 8.1%. But as we go, we might start the difference or the delta between this path that we're taking and the distance to last year's price. We could really shrink these gaps here. We've got pretty big gaps between these past 2 years. Home prices have gone up quite a bit. This gap may really start to shrink over this next year or two, meaning that home price appreciation will slow down some. But looking at historical markets and depending on the deficits in the market, we still could have very good home appreciation. I'm going to eat my words right now. I'm not going to say what I think is going to happen. I just want to watch what the data does over the next year. So that's real estate prices there. And then I went over that yesterday. So that's where I'm going to stop it. And right now, guys, things look pretty good. I think the S&P 500, the NASDAQ, looks like they want to go higher. Interest rates, they could go higher. We'll see what interest rates do. They're kind of consolidating right now. And the housing market looks like it's trying to kick back on a little bit, getting a little bit more interest in homes. It looks good for crude oil. It looks good for uranium. It looks good for a whole bunch of different sectors that I'm watching. They all look like they want to go up. So I think over the next 6 months, year, I mean, we'll see how long this lasts. I don't really know the length of it. Maybe it's a couple of years that we get this type of everything moves up together for a year or something like that, or two. And then we'll peak out and we'll have that crash that everybody has been worrying about. And maybe that's when the big crash comes. But again, I have to see inventory kick on up. I got to see supply kick on up. I got to see housing starts roll back over and go down. And I got to see all that. So right now, everything's looking good. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't. And subscribe to the website if you feel like. The Platinum membership's the membership I would choose. And don't forget about the Sunday 5 p.m. Mountain Standard Time meeting that we've got for Platinum members. All right, guys. Catch you later. This is Finding Value.